All right. Meeting is recorded. Okay. Okay, let me know when everybody's in and then we start.
Yeah, maybe a minute, not more. Yeah, people are coming in, so in a minute we can start. I'll let you know. Yeah, thank you. So, welcome back, Professor Kregel. So, let's start your third and final lecture. As before, we do, you speak for an hour, we take a short break, and then we come back. And just in case everybody doesn't remain till the end, I would like to take this opportunity to thank you very much for having agreed to deliver these lectures, for having done them so interestingly, and for all the participation and learning that has happened. Thank you very much, and over to you, Professor Kregel.
Okay, thank you, Jesse. You see, you've noted a very interesting thing about supply and demand. We note that in the financial sector, there's never any limit on supply. The banks can always create as much as they want. And when you get an old professor, there's no limit on the supply of words. They will be of infinite amount. So we try to keep it down to a limit. Now, what we're going to try to do today, and I'm going to give a summary when we start out now, so that if by the end I don't manage to touch all the points appropriately, we know what we're supposed to know when we finish. The first thing is we're going to talk about, obviously, finance of development. And we're going to do this, as we said, from the point of view of the post-Keynesian theory that we talked about yesterday. And in terms of our representation of these alternative views, these two alternative approaches to finance and the determination of output and employment in the system, the basic Keynes theory. Now, the first point that we're going to stress is that developing countries should never borrow finance from abroad. Now, this seems very extreme, but we will try to make the case of why this is a very simple rule. The second point is to look at the way the international financial system has been set up. And we're going to argue that the way the Bretton Woods system was set up basically reflects the approach to money and finance of the quantity theory and a system of banking which penalizes developing countries. That is, it prevents them from engaging in the most rapid and the most extensive type of development. So we're going to argue that the existing Bretton Woods system was a system which was set up in order to satisfy the developed countries and not to support the developing countries. Third point that we're going to make is that on the basis of the alternative explanation of finance, what we call the clearinghouse view or the unit of account view, there is an alternative to the existing Bretton Woods system that could be introduced on the international level, which would provide the possibility for generating international finance for development. And then finally, the last point is to stress that when developing countries are looking at the question of development strategy, they should always be focusing not only on their particular strategy, whether it be big push or whether it be a market-based approach or whether it be a general planning approach, to always look at the financing system that is going to support it. And that financing system should be basically domestic. That is, it should be generated as part of that development strategy. And this then fits in to what we started out with, and that's the argument that developing countries should not be borrowing from developed countries. So with that, to start, we have this mainstream, what we'll call the quantity theory approach to development finance. Now, what is that? Well, as we said, the traditional approach always starts out with constraints. The constraints are the existing resources and so forth. So if you believe that savings are necessary in order to finance development, in order to provide investment finance, you look at the standard developing country, and the argument is that because these countries have very low levels of per capita income, they're going to have deficient domestic savings. That is, they're not going to be able to provide internal finance for development. Secondly, we often argue that there's a scarcity of domestic resources. This I always find a little bit disingenuous. Why? Well, if you look at all of Latin America certainly was not represented by a case of scarcity of domestic resources. Indeed, that's why they became colonies. The Spanish and the Portuguese and everybody invaded Latin America because they wanted the resources that were there. And the same thing is true of the African developing countries and the same colonies, and the same thing was true of the Asian colonies. So this idea that there's a scarcity of domestic resources is a little bit strange. The problem is that the domestic resources have been exploited not by domestic residents and have not generated domestic returns, but they've been exploited by foreign investors, in particular, foreign direct investors. Finally, there's a deficient capacity to produce capital goods. Now, this has some relevance. That is, technical capacity is something that accompanies development. And basically, there may be a case to say that if developing countries have a scarcity of something, it's the scarcity of capital goods. And the question is then posed, should developing countries import those capital goods from the developed countries, or should they try to develop the capacity to produce them themselves? And we've already talked about the Chinese approach, which was to recognize their domestic capacity to produce high technology goods, but to launch a process by which now, some 25 or 30 years later, they are capable of producing domestically their own capital goods. So the question then becomes, well, it's quite simple. How do we overcome those constraints? Well, the first thing we do is we try to increase domestic savings, but this is virtually impossible because income levels are too low. So the natural result is some sort of external financing for development. Now, in the beginning of the 1950s, these arguments were based in terms of bilateral grants and concessional lending. That is, official development assistance was simply giving money to developing countries. Then you had the creation of the multilateral institutions, the International Bank, IDA, IFC, and so forth, in order to provide concessional lending. And most recently, after the breakdown of the Bretton Woods system in the 1970s, the concentration on foreign direct investment flows, that is, private investments providing the finance. But the basic point is that from the point of view, that is, if you adopt the idea that developing countries are constrained in this way, you naturally end up by arguing that you should be providing external finance. Now, in the period of the 1950s, a very sharp discussion went on between Keynesian economists and neoclassical economists. Jacob Weiner, who was an advisor to the United States Treasury and was deeply involved in the drafting of the Bretton Woods agreements, made the argument in a very straightforward way in a piece which he published already in 1947. The basic argument for international investment of capital is that under normal conditions, it results in the movement of capital from countries in which its marginal value productivity is low to countries in which its marginal value productivity is high, and that it thus tends toward an equalization of marginal value productivity of capital throughout the world, and consequently towards a maximum contribution of the world's capital resources to world production and income. Okay. Now, this argument says what? Well, what we should do is to simply have a free international capital market, and investors are going to automatically move their funds from developed countries to developing countries, because developing countries have a scarcity of capital and developed countries have an excess, a surplus of capital. In fact, this is the approach that was adopted within the United Nations and within most of countries' official development strategies. The first United Nations Development Decade, set up in response to requests from the Kennedy administration that was launching the Alliance for Progress, that is a project for increasing investment by US corporations in Latin America. And if you ask the question, why did this happen in 1960 and 1961? If you think what happened in 1959, there was a change in government in an island very close to the state of Florida. And the US government was concerned that those sorts of activities would be extended through the rest of Latin America. So the Alliance for Progress was an attempt, if you like, to buy off the Latin American country governments to avoid any sorts of change in government throughout the hemisphere. The objective was a 5% rate of growth of GDP, and the argument was that in order to do that, 1% of developed country GDP would have to be transferred to developing countries. Now, the assumption was that out of that 1%, 0.3% would be private flows, and this left 0.7% as the required ODA target. Now, that 0.7% target still exists. The group of 77 in China continues to exist, that developed countries should transfer 7% of their GDP to developing countries. They have never done it. They will never do it. And what we're arguing is that, in fact, probably it's not very useful for developing countries to have these transfers. We leave that to one side. At the end of the first development decade, this growth rate target was in fact achieved, and it was achieved quite easily. On the other hand, the official aid target, as I've already mentioned, was absolutely not achieved. Now, if we look at the argument that lies behind the idea of transferring finance from developed to developing countries, it's based on a number of simple assumptions. And that is the idea of diminishing returns. Capital scarcity in developing countries means that the rate of return on investment should be higher. Since there's a capital surplus in developing countries, the rate of return should be lower. Now, this is a simple application of supply and demand to capital, quote unquote, a thing which is called capital. And we look at it in a minute. The idea is that if you have a scarcity, that prices are going to be impacted. And if prices are going up, then the return to capital, which is the price of capital, will be high, so that there is an incentive for investors to increase their returns to investment by sending their funds to developing countries and investing in those developing countries. At the same time, developing countries are now going to benefit because they're going to develop more rapidly by borrowing capital from developed countries. And the result is that the global rate of growth and wealth formation will be maximized, that is, on a global level. Okay, because you're no longer wasting capital investing in developed countries when you can get a better return by shifting it. There's an additional argument, and that additional argument is in terms of demographics. The argument is that population growth in the developing countries is generally more rapid than it is in developed countries, and these developed country pensioners have to invest in order to live on their pensions, so that the developed country pensioners are better off if their pension funds are investing their money in developing countries, where the labor force is much younger and the return to investment is much higher. So you have this sort of dual support for this argument. It says that, if you like, this is sort of a win-win situation in which the developed and the developing countries both end up. Okay. Now, the problem with this support is that those assumptions cannot be verified. There's no inverse relationship between capital scarcity and rates of return. Indeed, if you think back to what we talked about yesterday, Rosenstein, Rodin, and Ragnar Nerks's example of the shoe factory, what was the rate of return to the shoe factory? It was negative. The shoe factory didn't make a positive rate of return. Their argument was that developing countries in general will have low rates of return, not because capital is scarce, but because demand is insufficient. The rate of return is determined basically by the level of demand. And the level of demand is created by, well, if you believe Rosenstein Rodin's theory, by the big push, or if you believe Nerkse, by the big bang. Now, the other problem is that it's not even possible to measure capital scarcity. And this was part of the alternative theory of distribution. Remember, the post-Keynesian theory of aggregate distribution talked about replacing the marginal theory. Well, one of the results is that it is not possible for capital to be measured accurately. Why? Because capital is not a natural resource. It's not like corn. It's not like land. It's a produced means of production. Capital is produced by, well, it's produced by capital and labor. So that the value of capital, the value measure of capital, is going to be determined basically by the distribution of income, whether capital has a high or a low return. Finally, there's no empirical evidence that foreign capital inflows increase domestic investment and growth. In fact, for most developing countries, the higher is the foreign capital inflow, the lower is domestic investment. And finally, if we think about this comparison of returns across countries, you can only have stable relative returns if you have stable exchange rates. And interestingly enough, stable exchange rates were one of the things which the Bretton Woods system determined. Now, in the late 1950s and the 1960s, as a result of the development of post-Keynesian theory, there was also a criticism of this marginal theory of capital productivity in terms of what was called the Cambridge capital theory debates. Many of you may be aware of the arguments that went on, but the basic result was that, first of all, there is no theoretical support for the assumptions about relative rates of return and capital flows. It's impossible to establish an inverse relationship between capital scarcity and rates of return. It's not even possible to measure capital scarcity. No. Okay. Nor is there any statistical evidence that suggests that this is the case. So that if we look at the historical record of what we call the net transfers of resources. That is, these are financial flows from developed to developing countries, and those financial flows are in terms of direct investment and debt service on the borrowing by developing countries. If we look, we can see that in the period 81 to 82, there was a short period until 83 in which developing countries received net capital from developed countries. Then there was a net outflow. It was more or less stable with net outflows. In the period of the 1990s, there was a period of sharp net inflows. And then starting in 1997, which for those of you who are from Asia will remember is the beginning of the Asian financial crisis. And as a result of the Asian financial crisis, there were very, very sharp capital outflows from developing countries to developed countries. Now, if we look at that line going down, blue line or the green line or the red line, these are to the various different regions. The explanation for this was what? Well, basically the explanation was that these represent developing countries holding increasing foreign exchange reserves in order to keep their exchange rates relatively stable. Now, as we said, this is what the IMF was supposed to be doing, but gave up doing after the 1970s, and basically represent what? Well, if you look at the figures here, we're down at 600 billion here for the total of developing countries. In 2004, 2005, these are, in simple terms, the holding of developing countries of US Treasury bills in New York, which means that what's happening is developing countries are financing the US government deficit by the purchase of US Treasury bills. So the idea that somehow or other developed countries are going to be transferring their funds to developing countries simply has turned out not to be the case. Yeah, here is the graph again. Here's the figure for 2006, developing countries, 661. And these are billions of US dollars. If we take Eastern and Southern Asia, which was the area which suffered the most from the financial crisis in 1997, fully half of that total is held by Eastern and Southern Asian economies. Now, basically what we experienced in this period was that throughout the 1970s, through until the current period, that the experience of developing countries that have been reliant on international capital flows has been primarily one of crises. Now, we used to talk about developing countries facing an external constraint, and that external constraint was in terms of a current account crisis, that is, with imports greater than exports. After the 1970s, once exchange rates became flexible, once international capital flows rose dramatically, developing countries tended to experience frequent, what came to be called capital account crises. Capital account crises which resulted from what? Which resulted from excess capital inflows into their economies rather than an excess of imports over exports. So we talk about this as the shift from current account to capital account crises. This nomenclature, those titles were invented, not by me, they were invented by Alan Greenspan, who was the chairman of the Federal Reserve in the United States in the period, in most of this period, that is after the 1980s. Okay. Now, we won't go through all of these crises. Now, there is a modern version of this traditional theory, and that's called real growth theory. We'll simply refer to it and say that what it does is that it now argues that the reverse of what originally had been argued, that Weiner had argued, that in fact investment in developed countries may have higher returns than investment in developing countries. And global financial markets may thus be efficient in producing negative net resource flows. Why? Because they argue that developed countries have increasing returns to investments in human capital, education, basically, and market institutions. Okay, we'll leave that theory to one side. We don't want to criticize it right now. It doesn't have much support to it. Reference we can now make is to go back to our development pioneers, okay? Calder, Nurkse, Myrdal, Rosenstein, Rodin, they all argued that returns to investment would be lower, not higher in developing countries, but not because of increasing returns to human capital, but simply because of deficient demand in the markets for developing countries. And also the basic idea that comparative advantage was not applicable to developing countries. Basically, the argument is that comparative advantage says that you don't want to build the shoe factory. What you do is, if you're a banana producer, you concentrate on producing bananas. And obviously, the rate of return in producing bananas is not something which is globally competitive. Now, the corollary of this position is the one which was put forward at one point by Lawrence Summers when he was Deputy Secretary of the US Treasury. And what he says is that, well, really what the US is really not supporting the fact of open financial flows from developed to developing countries. Okay. The reason for this, well, we have seen in recent months in Asia, as at many points in the past in other countries, the danger of opening up the capital account when incentives are distorted and domestic regulation and supervision is inadequate. The right response to these experiences is much less to slow the pace of capital account liberalization than to accelerate the pace of creating an environment in which capital will flow to its highest return use. And one of the best ways to accelerate the process of developing such a system is to open up to foreign financial service providers and all the competition, capital, and expertise which they bring with them. Okay? The argument here is what? The argument is that, oh, it's not the capital that's the problem. It's the fact that developing countries have distorted incentives and regulations. And to solve that problem, you should invite US financial institutions to come in and run your financial system. Well, this is a period when? In 1998, and this is the period in which, well, long-term capital management is going bankrupt and nearly bankrupted the entire US financial system because of distorted incentives, weak domestic regulation, and inadequate supervision. So this is really not much of a great benefit. Now, if we look, what do foreign financial institutions contribute? Okay, we have one very clear example, and that is the Latin American crisis in 2000 in Argentina. And we see that the foreign banks in Argentina in 2000, after the collapse of the Argentine economy, the foreign banks were the first to exit. That is, we have pictures of foreign bankers backing up enormous transport vehicles, piling US dollars into those trucks and sending them off to Uruguay. If we look at Brazil, we have a study which exists. Does ownership explain bank mergers and acquisitions? The case of domestic banks and foreign banks in Brazil, it shows that Brazil foreign banks are much less efficient than domestic banks. The foreign acquisitions of Latin American banks have been, well, obviously, if foreign banks are going to acquire domestic banks, what are they going to do? They're not going to acquire the bad banks. They're going to acquire the good ones. Okay, so the foreign bankers really don't provide, or at least this evidence suggests that they don't provide any direct benefit. Now, the question then becomes, why do we have this sort of paradoxical result? Why is it the case that foreign financial flows tend to go from developing to developed countries. Well, there's a very simple argument, and I'm going to give it very quickly. It was developed by a Ukrainian expat to the United States, Evzy Domar. You may be familiar with Domar as being the co-investigator who produced the equivalent of the Herod growth formula. We have the Domar growth formula. Domar made a very astute observation. He said, look, what you are forgetting is that if a country is importing capital or exporting capital, it has a counterpart in its current account. So a foreign balance in which you have a developed country lending funds to developing countries. This means by definition that the developing countries is going to have a capital account deficit. Okay? Now, this is simply balance of payments accounting. Now, he said, if you look at those balance of payments accounts, the capital account are simply financial flows and repayments of those capital. But the current account includes not only commercial balance, that is imports and exports of goods and services, it also includes factor services. Now, the factor services are what? The factor services are the interest that you pay on the foreign borrowing. So he said, look, if a developing country is borrowing capital from a developed country, it gets a credit, that is the foreign capital that it can invest, but it also has a debit, and that debit is to pay the interest, the debt service on that foreign borrowing. And that appears where? Well, it appears as a credit in the current account of the developed country. And Domar did his calculations, and he said, look, the difficulty here is that unless the capital that you're borrowing generates a rate of return which is sufficiently high in terms of foreign sales, that is the generation of foreign currency, okay, the interest payments will eventually exceed the amount of foreign borrowing. So he said, look, there is a solution to this. And the solution to this is what? Well, the solution is that if a developing country is increasing its stock of foreign borrowing at a rate which is just equal to the interest rate that it's paying on its foreign borrowing, then it's possible for the debt to GDP ratio to stabilize, to become stable. That is, it won't collapse. Okay. Now, what does this mean? Well, in simple terms, it means that, if you borrow, if you're a developing country and you borrow up 100 from a developed country, and the interest rate is 10%, okay? You borrow the 100, and after the first year, you have to pay back 10. And what Domar says is that if you manage to increase your stock of foreign borrowing by the same rate as the interest rate that you're paying, that is by 10%, okay, then the situation might be stable. Now, what does that mean? That means that what you're going to do is that at the end of the first year, you're going to borrow from the developed country an additional 10, which means that your outstanding debt to the developed country is now 110. But 10 of that 110 you're going to use to do what? You're going to use to repay the interest, or to pay the interest on that foreign loan. Okay? So if you can continue to do that, and you can do the calculation, after the next year, you're going to have to increase 110 by 10%, which is going to be 11 and something, and so forth. And the situation goes on very nicely. Unfortunately what? Unfortunately, there should have been another slide there, but it's not there. Unfortunately, have you ever heard of Ponzi finance? Domar's solution is a formal definition of Ponzi finance. Okay, If you're a Ponzi financier, what do? You borrow from new investors the amount that you use to pay off existing investors. Now, we know that Ponzi finance schemes can't exist. Why? Because eventually you run out of people who are willing to lend you money. And this is precisely the same thing that happened in the 1970s, the 1980s, and the 1990s to developing countries. Private lenders lent money to developing countries, and they continued to lend money until they discovered that the developing countries could not pay them back. And why couldn't they pay them back? Well, how do you pay back a foreign loan? You pay back a foreign loan by running a current account surplus. But if you're borrowing, if your capital account is net positive, it means you've got a current account deficit. So you have an impossible situation. In order to finance or to repay, you have to run a current account surplus. How do you run a current account surplus? Well, you run a current account surplus by cutting down your growth rate, by reducing your investments, and, well, basically creating a financial crisis. So basically what happened was that this foreign borrowing was generating, according to the DOMAR rules, persistent financial crises as these Ponzi financing schemes broke down. Now, if we look at the drivers of private financial flows, there are two very nice books that exist, one by Michael Pettis called The Volatility Machine, in which he explains that basically it's the excess liquidity creation of developed financial markets that drives financial flows to developing countries. Okay, that is, yes, Viner is right. Developed country markets will transfer funds to developing countries as long as they think the rates of return are high enough. But when they discover that they can't get paid back, then they pull their money out and they create a financial crisis. The other is the book called The Loan Pushers by Sandy Darity and Bobby Horn, in which they argue quite persuasively that the developing countries, in fact, never asked for this money. It was the developed country bankers who required them. So, well, now we get to the slide which should have come before the last one. That is that you end up with this DOMAR paradox. Foreign lending is a Ponzi scheme, basically. And DOMAR's solution is a Ponzi solution. So this is the argument when I said this is rather an extreme position, which said don't borrow foreign funds. And the reason for this is that in 9 cases out of 10, you're going to end up in a position in which you end up with a financial crisis. Now, Keynes clearly saw this DOMAR solution. In the last paper he wrote, we find this phrase: it is obvious that no country can go on forever covering by new lending a chronic surplus on current account with eventually forcing a default from the other parties. Okay, and that means what? Well, it means that if you continue to run a development strategy which is based on foreign borrowing, eventually you're going to end up with, well, default, a financial crisis. Quotation from James Mead. During the Bretton Woods discussion, Keynes made one of his brilliant introductory talks in the course of which he described White's ideas, these are the ideas behind Bretton Woods, as bedlam, and his drafting as positively Sumerian. Sumerian means that it was written in script that nobody could understand, and gave us, by way of a digression, a marvelous proof of the fact that international investment always has been and always should be defaulted. Okay, so this is our basic argument. Now, if we look at the Bretton Woods system, okay, this gives us the explanation of why the Bretton Woods is not development friendly. Right? The first argument is that Bretton Woods was designed to produce stable exchange rates. Okay? Now, exchange rates are going to be stable if foreign currency inflows equal foreign currency outflows for every member country. Foreign exchange is generated by what? It's generated by your current account balance. If you have a current account surplus, you earn dollars. If you have a current account deficit, you owe dollars. So if the exchange rate of your currency is going to be stable, then owing dollars And earning dollars has to balance. So basically, this means that over time, the current account of all of the members of the Bretton Woods system have to be balanced. Now, if they don't balance, what happens? Well, if they don't balance, then you use your accumulated exchange reserves. Those accumulated exchange reserves allow you to offset a deficit on your external account. Until what? Well, until they run out. And what happens when they run out? Well, when they run out, you have to go to the IMF, you borrow dollars from the IMF, and the IMF says that we will lend you these dollars in exchange for your own currency, but only on condition that you introduce an adjustment program. And that adjustment program is what? That adjustment program is to reverse your current account deficit and create a current account surplus. Now, how do you generate a current account surplus? You do that by selling more bananas. But unfortunately, it's very difficult for developing countries to expand their exports in order to adjust their external account. So the alternative is what? Well, the alternative is cut down government expenditures in order to reduce consumption, to reduce growth, and to reduce development. So basically, this means that a development strategy for a country that was based on, as we said, you might want to import capital goods, that would be a current account deficit. That current account deficit could not be persistent over time, because eventually what would happen is that, well, you would not have the funds in order to pay for them. And the only way you can pay for them is by earning dollars. And how do you earn dollars? By running a current account surplus. Running a current account surplus means reducing your imports. Now, if we look, this is the basic arguments that Nicholas Calder has used in order to criticize the IMF. We'll skip over these because we don't need them, and we'll shift now quite quickly to the question now, if we don't have external finance, where is the finance for development supposed to come from? Okay, if foreign finance is included, and the answer, we argue, is to be found in the development of domestic financial institutions. Okay, remember Schumpeter, in his early work, pointed out that it is the role of the domestic banks to finance innovation, and that there's no limit on their ability to generate purchasing power over domestic goods. We look at the theories of Sismondi, the recommendation of industrial banks in France, and also in Germany. If we look at the development of the German economy was industrialized by means of a range of industrial banks. Now, these industrial banks were what? Well, the industrial banks were slightly different from the banks that we see today. We normally think about a bank as something which provides deposit accounts or transaction accounts. These were not, industrial banks were not deposit banks. The German banks were not note issuing banks. These were the equivalent of what we would today call investment funds, or the private equity funds. That is, individuals, rich individuals, landowners, would band together, form an industrial bank, and those banks would finance the development of domestic industry. And in this particular case, what would happen is that normally these banks would own the industries until they had demonstrated an adequate rate of return, and then they would use the equity market to sell them. So that a typical industrial bank would invest in a company, and it would develop that company, it would manage the company until it had produced a satisfactory position in the market, and then it would sell them into the market. So we already have a historical example of this case. Now, The alternative that we have is to say that there are alternative ways, aside from these industrial banks, of providing these kinds of development finance. And it's at this stage we can talk now about the extension of the kinds of systems that we've talked about as unit of account systems or clearing systems. Okay. Now, if you think of it this way, on a system which is based not on a pure commodity money, but on a unit of account or a credit money, and ask the question, where does the creation of finance come from? Well, the creation of finance in these sorts of systems comes from the basic clearing mechanism, okay, in which debits and credits are matched by bookkeeping operations. So if we take an example, if all of us who are listening today were all part of a clearinghouse, okay, and each one of us is a producer of something, it's because we're producing things. What do? Well, if we produce things, we have to buy inputs from somebody else so that I can input something from somebody. And in doing this, what do? I don't pay him directly. I say, okay, I owe you. You have a credit with me. Now, I have a debit with you. And we go to the clearinghouse, and in the clearinghouse, in my account, there is registered that I have a debt with you. You, in your account, you have a credit with me. And automatically, we have created the possibility of financing my production. Now, we have the question to say, why would people be willing to do this? Why would you be willing to take from me a credit? And the simple answer is that you are also going to have an operation in which you're going to be buying something from somebody else in the system, so that you're going to have a debt with somebody else. Now, the person who is keeping the books or the clearing union or whatever the central authority is, okay, has a debit for me to you, you have a credit with someone else, and you have a credit relative to me. Now, I don't have to actually make the transaction. The banker, the bookkeeper, whoever it is, simply looks and says, okay, I see you have a credit here, you have a debit here. So what I'm going to do is to match those debits and credits so that you automatically now use the credit that you have with me to pay off the debt you have with someone else in the system. Okay, and the system works why? Well, the system works because, okay, we have integrated production in the system. Everybody in the end, if you like, owes something to somebody else. And this is why you're always willing to take a credit, because you can use a credit in order to pay a debt. All right. You don't need a piece of gold. You don't need a commodity. You don't need anything like this. Now, in this sense, what happens is that those credits, okay, are created automatically. Okay, they're created automatically simply by the productive activity that's engaged in the system. So the argument is that instead of having the banking system that we currently have, that is the banking system which says that banks are lending, okay, you don't need those banks to lend. I don't have to go to the banker and borrow from the banker. Okay, effectively what I'm doing is I'm borrowing from you. You're granting me the credit. And why are you granting me the credit? You're granting me the credit because you have a debit with somebody else in the system. So you have this systemic creation of a means of payment, of what we call liquidity creation, inside the system. Now, basically, when Keynes, well, we can look at that, made the argument about the clearing union, all he did was to take this system that we've just described amongst individuals and extended it to the national level. Okay, so he said, if I take country A is going to have a current account. That current account is going to be in surplus or in deficit. If that current account is in deficit, okay, there will be a central bookkeeper. There will be a unit of account. That unit of account is going to be suggested that it be called Bancor, but there were a number of names that were used. That is, that the country that was in deficit, okay, would have a debit on the account, the global account, and the countries that had sent their exports to the deficit country would have credits. Now, as Keynes pointed out, since these are all voluntary exchanges, the debits and the credits have to match so that the system, in fact, normally cannot fail because a debit is always equal to a credit. And number two, that if countries are in a position where they have different levels of development, okay, if you have developing countries that have decided on a development strategy to import capital goods from developed countries, what would happen? Well, the developed countries would end up with credits, the developing countries would have debits, those would be matched, that is, the credits and the debits would simply be offset against each other, and automatically you would have the financing that would be required in order for the developing country to continue its particular development strategy. Now, if we look at the difference between these two systems, many people say, well, the Bretton Woods system was almost the same thing as Keynes' clearing union. No, it wasn't. Because, as we've seen, under the Bretton Woods system, what happens is that the IMF lends money to the developing countries which have to be paid back. The IMF lends the deficit country, okay, its own liability, just as if it were a bank. But in Keynes' proposal, it doesn't behave as if it is a bank. It's just as we said, it's a system in which you're offsetting debits and credits. And automatically, the developed countries are creating credits that are generated by the developing countries. Now, again, you make the question, why would developed countries be willing to do this? And we can simply go back to the old Prebisch argument. Developed countries would realize that if developing countries are engaging in a positive development strategy, they become clients for the additional exports of the developed countries. And the question is, how are the developing countries going to pay for them? Well, they pay for them by the fact that the developed countries have credits relative to the developing countries. So the system provides, if you like, a sort of automatic system of financing. Now, the basic criticism that was used in this theory was what? Well, the argument was that the United States would always be the surplus country. Why? Well, at the end of the war, the United States had all the gold, it had all the productive capacity. Developing countries, well, at the end of the war, developing countries were not even yet independent countries. So the argument was in the US that the US would always be the country which had the current account surplus and would always be the country that was lending to the rest of the world. And in the United States, the congressman said, well, probably all of these countries are going to default because they don't have any productive capacity in order to repay us. And that was basically the reason why the system was rejected. Now, we have today the possibility of introducing this sort of system. Okay, because if we think about this business of the bookkeeper and everything else, it sounds very, very complicated. All right, remember this when Keynes talked about bank money, or Ricardo talked about the bankers doing debits and credits. This is sort of, this, you can see the clerk sitting there writing these things into the accounts. Well, today we have a revolution in information technology, and that information technology suggests that it would be possible to create an automatic clearing system run by a very large computer, in which all transactions by every country in the system was recorded, and which they were offset, and we would have the accounts that existed in the system. Now, the question is, would it be possible to do that? And I would argue basically that yes, it is possible to do that. Why? Well, there are two examples to this. The first example is as a result of the creation of Bitcoin, the US central bank is considering the possibility of creating effectively a digital dollar, what is called a central bank digital currency. And the Federal Reserve Bank of Boston, with MIT, has run some tests in order to see if all of the transactions that are currently provided in the US economy could in fact be done by means of a centralized Federal Reserve computer system. And the answer is yes. That is, it would be feasible. Now, the interesting part of this is what? The interesting part of this is that if the central bank provides a digital dollar, okay, that digital dollar would also be a substitute for a deposit account in a private bank. Why would you choose to hold a deposit account in a private bank when you can hold a digital dollar in the central bank? One of the reasons why private bankers are not very keen on this kind of system. And this was also one of the resistant points when Keynes made his original clearinghouse proposal. The international bankers recognized that if you set up an international clearinghouse based on a common unit of account, it would no longer be necessary. It would no longer be necessary in order to have the private banking system. So this is one of the difficulties we're facing. But the point is that this type of system would generate the possibility of automatic development financing within the system that was not foreign direct investment and was not generating actual debt service, and would not then generate the kinds of financial crises that we've looked at. Okay, at this point, what I think we should do, what I would like to do, is to take the break, and then we'll go back and pick up the argument here in terms of the extension that have currently been made and currently exist of these international clearing proposals. Now, let me see if Jessim is ready to go. Okay, I told you I would be very prompt today. Okay,
Thank
so
you so much. 10 minutes. Thank you.
Okay. Oh.
Welcome back. Maybe we should start. We should restart.
Okay. Okay. Now, what I want to do is to go back and recover this piece that we skipped on the way to the clearing union. And this is basically the explanation of these two different, why we have these two different types of banks and why the clearing union is a different system than the one that we have under Bretton Woods. Now, we've already talked about this idea that in the clearinghouse or the bookkeeping bank approach, The creation of liquidity comes from what we would call systemic liquidity. That is, it comes from the fact that individuals are effectively granting credits to other individuals in the system, and you end up, or the result is what we currently would now call an emergent property of the system. That is, the systemic liquidity is generated by the individual actions of production and the granting of credits by each individual inside the system. So if we take that approach, then what we're saying is that financing is created simply by the existence of this systemic matching of debits and credits in the system. And the way the system would function is that you have to have something or someone or some institution which provides the centralized netting of debits against credits. Now, as I've already mentioned, this is not the way private banks currently function. Okay, private banks currently function by basically issuing their own liabilities, that is in terms of banknotes or in terms of what we call sight deposits. And if we think about the development of the financial system, we've already noted Einaudi reference to the existence of imaginary money. We have several examples of these sort of netting systems. The Bank of Amsterdam, for example, represented basically a netting system. That is, it didn't issue its own liabilities. It simply kept the books of the members of the Bank of Amsterdam. And this is today what we would call a gyro bank or a hero bank, in which individuals would deposit gold in the Bank of Amsterdam, and the gold would never leave. And when they had to make a payment, they would go to the counter at the bank and say, I owe Mr. X so much, and the bank would simply credit Mr. X's account for the amount and debit the account of the payer. Okay, and as I say, we do have historical examples of this. Now, in order to understand this, we can say that it's possible to make a distinction between bankers as providing financial services, that is, making payments, relative to bankers providing means of payment. Okay, making payments is what? Well, basically, the example that I've just given, the Bank of Amsterdam provides a service. The service is debiting and crediting the accounts, and it makes payments on behalf of individuals, so that the individual A who goes to the bank doesn't have to pay anything to individual B. He goes to the banker and he says, look, simply debit my account to so much, credit the account that I want to pay so much. And the banker says, thank you very much, I'll do that. And what he's done is to provide a payment service. Okay, now, in this transaction, there is no what we would call means of payment. There's nothing physical that moves. You don't move gold, you don't pay a check, you don't use any physical representation of the fact. This is simply a service that the banker gives you. Now, in general, we can understand how these financial services might eventually, okay, generate the creation by banks of their own assets. Okay, so if you're a banker, okay, and you're providing payments, and somebody comes in and says, look, I need to make a payment to Mr. B, but I don't have a sufficiently large credit in order for you to debit my account and credit the payee's account, the account I'm trying to pay. Okay, a banker can look at you and say, well, no, too bad, you can't do it. Or the banker might say what? Well, since I'm keeping the accounts, I can always open an account for myself. And what I'm going to do is debit your account, credit my account, and then debit my account in order to credit the payee's account. Okay? I'm going to become an intermediary, a middleman. Now, what have I done when I do this? Well, basically what you're doing is creating credit. But whose credit are you creating? This is not systemic credit. This is the banker's credit. Okay? The banker now has a debt that he's created relative to himself, so that the banker, okay, now is exposed. What if Mr. A never comes back and says, okay, I now have a credit in the system that I can use in order to offset the payment that you've made for me? Uh-oh, the banker is in trouble. And this is basically the way, in general, almost all financial institutions, okay, are generated, and all financial innovations are generated. Okay, for example, if you take a simple example of an interest rate swap, an interest rate swap is offered by what? Well, in the beginning, you had individuals who were borrowing funds by issuing fixed rate bonds. Okay, if you're a big institution, you can issue a bond that pays X% per year. Okay, if you're a smaller institution without a credit rating, you may be borrowing short term in the market and paying the market rate, a fluctuating rate. Okay, now what a clever banker did, and this is confirmed by history, what the clever bankers did is they said, okay, I have a client which is a fixed rate payer and I have a client that is a floating rate payer. What I'm going to do is going to allow them to bring them together so that they can swap, so that the fixed rate payer might decide to pay a flexible or a floating rate, and the floating rate payer can charge a fixed rate. Okay, they simply swap the interest rates amongst them. And what does the banker do? He simply brings them together. Okay, he matches them. And this is the same thing we said that the banker did under the clearinghouse or the unit of account approach. Now, what happens if the banker has a client, say it's a floating rate client, and he can't find a fixed rate payer? Okay, if you're a clever banker, what do? Do you send the client away and say, sorry, I can't help you because you don't earn any money if you don't bring about a marriage between the fixed and the floating rate payer? What the clever banker does is to say, well, what I'll do is I will take the other side of the transaction. I will provide a fixed rate for you against the floating rate. Right? Now, when the banker does this, what happens? Well, instead of simply doing this matching, and we said that the matching was riskless because the credits and the debits always matched, now the banker is taking on credit risk. That is, he's promising to do something that he does not have a counterpart. Okay? And this is basically the kind of financial system, the private financial system that we currently have, is that bankers, when they create deposits, deposits are liabilities. That is, if you give a banker your deposit, the banker says to you, I promise to repay to you, okay, that money that you've given. Now, what is the banker going to do with the money? Well, he's using it, okay, to lend to somebody else in the system. So the banker has now taken on, as we say, created a financial asset, which is his liability, which is the deposit, and he's created a risk, and that is a payment risk. What if the system doesn't match? Well, it doesn't match. Why? Well, it doesn't match because, as we now know, that bankers, as Schumpeter told us, can create money out of nothing. This is how bankers create money out of money. So this is the basic argument, is that if you look at the Bretton Woods system, The Bretton Woods system is what? The Bretton Woods system is based on countries depositing, okay, the quotas that you pay into the Bretton Woods system are the monies that you deposit with the IMF. And the IMF is able to create funds against those deposits. And you're always liable to repay those deposits. Okay, and that's why there's this basic difference between the system. The IMF acts just as if it is a typical banker, while the clearing union, there is no banker. The liability is not of the central institution. The clearinghouse doesn't have the liability. The assets and liabilities are all with the current member states. So if you look at the system, if you go through the literature, it was very common for bankers before they started to take on credit risk to use this clearing mechanism. Here's a quotation from Mises. And basically what you could argue is that bankers have moved from being simply the agents or the brokers to being principals or dealers. That is, moved from simply matching assets and liabilities of their clients to issuing their own liabilities to clients in terms of lending for financing. Now, it's that lending to financing that creates the financial instability and creates that DOMAR problem. The DOMAR problem comes why? Because you have to pay interest to the banks. In terms of the clearing system, you don't need to do that. Why? Well, if you look at Keynes' argument here, as Keynes notes, you need capital if you are not in a closed system and have to meet liabilities for credit outside your system. If there are numerous domestic clearing systems operating simultaneously, then bankers may have to make payments outside their proprietary system and either a generally accepted means of settlement, which will normally be the role of money proper. Okay, so this is the basic argument. Now, there is an addition, a current addition to yeah, we've done that. There is a current addition, which or supplement to Keynes' system that was put forward by Schumacher and then eventually by Koleski. And that argument was what? That argument, now I'm looking for the, yeah, here we go, augmented clearing, Schumacher's pool clearing. This system provides the possibility of actually eliminating, okay, the dollar as the global currency. Now, Schumacher's proposal works like this. He says that you create in each country a clearing pool or a national clearing fund. Okay? The national clearing fund, okay, receives from importers and exporters the debits and credits which they earn internationally. So if you're an importer, okay, you need foreign currency. If you're an exporter, you're earning foreign currency. So the national clearing fund for each individual country simply matches the debits and the credits from national importers and exporters. If the country has a deficit, okay, that deficit is recorded in the global clearing. If the country has a surplus, okay, that surplus means what? That surplus means that you're going to have the National Clearing Fund is going to have a surplus. That surplus is then invested in domestic treasury bills, okay? So that you have each National Clearing Fund, which is matching importers and exporters' needs for foreign currency. if there is an imbalance, that imbalance is matched by investments in domestic treasury bills. Those treasury bills are then transferred to the global clearing or the international clearing office. And the international clearing office then simply matches the debts and credits for each national country. Now, the result of what? Well, in this way, every national currency, okay, remains. You don't have to eliminate dollars. You don't have to eliminate rupees. You don't have to eliminate pesos. Each country keeps its national currency. There is the world unit of account, which the clearing fund uses, but that clearing fund, okay, has units of account which don't trade and are not used as means of payment. They're not lent directly to anybody. What is lent is a share of the credit countries in the treasury securities that are purchased by the deficits of the debit countries. So that basically what is happening is that the credit countries as a group are investing in the treasury bills of the deficit countries. And those treasury bills are still traded on the domestic treasury market, and they're traded in terms of domestic currencies. So that with this sort of procedure, the creditor countries are never creditors directly on a bilateral basis, and they're never lending funds directly to a deficit country. So the problem that we talked about of the US Congress worrying that they would be lending money to European countries, no, they wouldn't be lending directly to European countries. They would be lending through their current account surplus, through their credit position, to holding a share in the treasury bills that would be issued by the deficit countries. Now, this is one way, one possible way of getting around this problem of avoiding this business of bilateral lending. Now, in the Bretton Woods system, what happens? Well, if a country goes into deficit, it goes to the IMF and it says, here is my domestic currency, give me, and almost always it asks for US dollars. Give me US dollars. So you always have a bilateral relationship between the deficit country and the United States, intermediated by the IMF. With this sort of system, there's no direct bilateral lending of dollars from the IMF directly to deficit countries, and there's no need, in this case, for the deficit countries to actually engage in indirect debt service. Okay, so the basic idea is that if we look at this idea of the alternative money creation, okay, we have the necessity or the possibility of providing these alternative mechanisms. For example, now there are many local currencies that have been set up. These local currencies are set up on the same principle. That is, the local currencies are set up on the principle that basically purchases and sales are always netted by people within the local area. And you have the possibility at the same time of creating liquidity in the same way. Now, the difficulty in understanding or appreciating these systems is that we're so used to looking at borrowing and lending, okay, in terms of operating against a bank, against a financial institution, that it's very difficult to think about this borrowing and lending taking place on a systemic basis. Okay, as I've mentioned before, under the clearing system, you're not doing any bilateral relationships. The liquidity is not created by any individual country. It's something that emerges by means of the creation and the production of output inside the entire system. Okay, now let's break off here and let's go now to take some questions, because clearly, yeah, okay, this is. Okay, Fidelis, you're first one that I see there, so let's.
Thank you so much, Prof. I enjoyed your lecture so well, and I'm beginning to take some topics that I may be working on in future. So in line with that, I would want you to clarify to me what alternative debt policies do you think developing countries, for that matter, African countries, should undertake? Because we've seen that many African countries are defaulting in paying their debt. For instance, Ghana, Namibia, Ethiopia are defaulting in paying their debt. So what alternative debt policy should these countries adopt? I'm saying that because of the premise you made concerning how businesses can credit and debit each other without necessarily having to talk of what do you call it, insufficient credit. So I don't know if the two can link, but what would you say the alternative debt policy should be? Thank you.
Okay, the first problem that we have to recognize is that, as I mentioned, the way the financial system is currently set up, the financial institutions are private, number one. And number two, okay, they are undertaking the risk management of the loans. That's why the debt problem is a problem, because if you don't repay the debts, what happens? The financial institution is in difficulty. And if the financial institution fails, then the entire system pays, right? Now, if you happen to be a rich country, then you can support your financial institutions. The United States now, we support the failing bankrupt financial institutions virtually every 10 years. Okay, if you think back to the 1980s debt crisis in Latin America, all US banks were technically bankrupt. They were bailed out by the government. If you look at the position in after the great financial 2007-2008 crisis, technically all of the financial institutions, okay, were bankrupt. The government bails them out. Okay, now the developed countries survived because they could do that. Developing countries can't do that, and this is why non-payment of debt is a problem. There's no government that can absorb. There's no society that can absorb that debt. So it gets paid how? It gets paid through a financial crisis. Okay, that financial crisis then creates, in almost all cases, those negative net resource flows that we saw. Okay, those negative net resource flows are what? These are developing country, okay, payments that are going to developed countries in order to bail out their banks, because the banks are technically insolvent because the developing countries can't make the payments. Okay, so my first argument was, well, you shouldn't have gotten into this difficulty in the first place, but that you can't do now. Okay, once you've got the debts, you've got them. So the question is, how can we manage, okay, these problems? And the problem first is to say, as I said before, as long as these are direct country to bank or country to country debts, you're going to have difficulties. The basis of the clearing union was what? It was to put these payments on a multilateral basis. Okay, the idea was that you should have multilateral clearing of debts so that if there was default, that default didn't have to be paid by a single country. It was paid by all countries taken together. Okay? Now, this is usually what? This is called an insurance policy. Okay, what happens when you buy insurance? When you buy insurance, the insurance company says, we will cover you against a particular kind of risk. And we can do that because not everybody is going to ask us for money at the same time. Okay, there are lots of people who think that insurance companies are Ponzi financing. Why? Because you pay your premium and you're not sick, and that's what allows the company to pay the people who are sick. Okay, so the question is, can we set up that sort of multilateral basis? Now, Keynes with the clearing union, he said, let's do it for the entire world. Well, that didn't work out so well. At one point, he also said, well, we could do this on a regional basis. Okay, why don't we do this in terms of getting groups of countries together? We could have regional unions that would work. And this would be one sort of possibility, okay? Because if you look in general, okay, there are interrelationships that go across regions that are stronger than the relationships that go between the borrower and the lender countries. So that would be the first step in trying to move out from this. Now, the other problem is that basically, remember the quotations that I had from Keynes? He said, in general, these loans should all be defaulted. Okay? In the end, that's what's going to happen. If we look at the debt crisis of the 1980s in Latin America, okay, we found a system in which they were partially defaulted. Now, is that a bad thing? Well, basically, if you look at the operation of banks, okay, banks always make losses on some of their loans. Okay? Some of the loans don't pay off. So the question is how you can arrange the fact that the countries are no longer able to pay without the costs of that being borne by the country itself. Okay. Now, as I say, this is always a difficulty because you're starting from a given situation. Africa has outstanding loans, and it would be very difficult to simply cancel, default on all of those loans. But if it were done on a regional basis, that would be a start. Okay, who is it? Who did we have? Okay, we have.
Hello.
Yep.
Hi, Professor. Yes. Thank you again for this wonderful lecture. Lots to think about, and it is very dense. So I was just wondering, just a comment first, because I remember seeing this work of art. It was a piece of video art made by, I believe, a bunch of heterodox economists regarding the current functioning of the financial system, the global financial system. I believe it's called the waterworks of finance, the waterworks of money. And it's just a comment because I found it really brilliant. It described a lot of the functionings of the current system, but what you described as the alternative, I was it was just this is just a comment again. I wish there could be a similar visualization of the proposals that you have made. It's just a wish of mine, a desire of mine. That would be really nice to see, because again, many of these complex ideas, I think, are often also, they can be visualized and carried across very in a way that really connects. But anyway, sorry for this brief comment. Sorry.
Okay, I can give you a little hint. There is a private clearinghouse system that exists, and it is now, produced a number of background things, and it's adopted a number of things that I've written as well, called WebTel. So it's WebTel Mobi, webtel.mobi. And if you look at that website, you'll see a whole series of background things, including a diagram of the way their clearing system works. Okay. Now, one of the interesting things is that this is a private system. Okay, it's something that has been set up by some clever private individuals who obviously understood how clearinghouses work, and then decided that, well, I have the IT technology which allows me to do this. I don't need I don't need the bankers and the account books anymore. I can simply run this through a large computer, and I can provide the same kinds of payment systems that we've always done. Now, my argument here, or the importance of this, is that, well, if the private sector can do this, there's no reason why governments couldn't do this. And as I've mentioned, a number of central banks are now working on central bank digital currencies. But we have the difficulty that if you think very clearly about those central bank digital currencies, the private bankers, okay, are going to be in great difficulty. Why? Because if I can have a digital account in the central bank which competes with the digital account in my local bank, okay, which one should I choose? Well, if I'm risk averse, I know that my local bank, okay, has a possibility of going bankrupt. The central bank, not so much. So you have the difficulty that the central bankers are facing, is that they're under a great deal of pressure from the existence of the cryptocurrencies, where people say, well, I can always use a digital currency. I don't need my private bank. And the government says, well, this is an increase in risk. Maybe we should do it ourselves. So you get a lot of resistance from the private sector until the private banks themselves decide to introduce these sorts of systems. So eventually, I'm saying it's how should we put that? You have one alternative is to say, well, you could introduce this from the top. Okay, that's what the Bretton Woods system tried to do. It said, okay, we've got everybody together and everybody's going to do this. You either like the Bretton Woods system or you don't. If you don't like it, go away. And this is, well, at the time, Russia decided that it didn't want to play in that particular game. But this is a system now which is coming up from the private sector. The private banks are starting to do this. Okay, you've seen now, even we have crypto ETFs. You can buy an ETF that a regulated financial institution is running that has as its assets Bitcoin. Okay, so eventually it's going to be the technology which is going to push us. And the technology obviously has a net advantage. And that advantage is what? It's in running a clearinghouse. Basically, that's what the technology is there for. If you think of it, all a bank does is simply to match its assets and its liabilities. And if it does it through a computer and it does it through its own unit of account, okay, then you get pressure on the system.
Right. And if I may, regarding, like you mentioned, even though these proposals exist, which are clearly in a progressive direction, attempts at de-dollarization, looking at what's happening in Argentina right now, can we just ascribe these failures to go towards these progressive directions just due to private banks, money issuing banks feeling threatened, or I mean to say more of the what are the political economy constraints to such adoption, adoption of these policies?
Okay, I've already mentioned the 1980s financial crisis in Latin America. Okay, now we represent that as a Latin American crisis, but it was equally a United States banking crisis, because technically all of the banks that had participated in lending to Latin America, and these were the largest banks in the United States, they were all technically insolvent. Okay, now if legislation, existing financial legislation and regulation had been employed, you would have had to shut down these banks. Okay, now if you're the government and you look at this and you say, well, if I shut down all of these banks, what happens? The economy collapses, basically. So what are you going to do? You're going to step in and you're going to bail out the banks. And well, we now call it bailing out. What we do is to validate the outstanding liabilities of the banks. Basically, what we said is that anybody who had a depositor in these bankrupt banks, those deposits would be made good. Okay, so this is the kind of pressure that the bankers have. Okay, so the bankers go to Washington and say, well, no, if you don't do this for us, we're simply going to shut down. And if we shut down, then the economy collapses. So if you look at, as you say, the political economy behind this, the political economy by this is that the bankers always have, okay, dominance over the government, because the government is not going to allow them to fail. Okay, they've got them in a position where they have to bail them out. Okay? Now, the only alternative to this is what? The alternative is to have a banking system that doesn't get into those sorts of difficulties. Now, as we said, the clearing system doesn't get into that kind of difficulty because the clearing system doesn't lend. Okay, so this is the basic alternative that you're looking at. But as you say, what is the political economy behind it? The political economy is that if the bankers that currently exist see this happening, they have a choice. Either they can fight, and what they've been doing is resisting as much as possible, until eventually they decide to join. So if eventually they decide to join, that's fine. But if you look at the returns to a bank inside a clearing system, the returns are, well, they're going to be very much smaller than the returns to the current banks are today. So again, you're going to have this resistance inside the system.
Thank you. Thanks. That made a lot of sense.
Yeah, hi, Professor. So maybe a lack of clarity on my part, likely a lack
Oh,
of
here's
lack of
Ritvik. Yes.
yeah, likely a lack of clarity on my part. So I understand how the system can resolve some issues that are there currently in international financing, national financing. I just want to imagine a couple of situations, and maybe you can help me sort of understand how the system functions there. So one is the obvious question of what happens if a country's debits or deficits keep ballooning, right? So a lot of countries don't end up being, or may struggle to be in a surplus and may struggle to pay back. Now, you said that if a country is in a deficit, then the surplus countries, let's just take them together, that surplus is invested in that deficit country's treasury bills. But if you're investing in a treasury bill, still interest has to be paid on that, right? So even if it's not in the international currency, those forex problem is resolved, but you still have to pay back, right? Now, in a situation where this increases, or let's say there's some kind of crisis, which is not a financial crisis, but just say the pandemic produced a bunch of crises here and there, affects demand substantially. How does this system deal with elements of power and coercion? And I'm not even going into the question of whether the system gets adopted. Let's assume it's adopted by everyone. Countries which are quote unquote racking up debits would they be in a position then where they have to substantially alter how they structure their economy? Would they have to sell their natural resources for cheap? Other kinds of sort of quote unquote adjustments that the IMF imposed on people. Essentially, what I'm trying to get at is how does power and influence play out in the system, assuming everyone adopts it? Or does the system prevent that from happening? Because to my mind, power and influence really doesn't go anywhere. Let's say a country really wants to rapidly industrialize, or not even rapidly, but wants to industrialize and needs imports of capital goods, which cannot be produced domestically. Then how does the system facilitate that in a manner which is stabilizing for that country, and protecting them from the influence and power of the currently advanced countries?
Okay. If we go back to the period in the 1950s, okay, the IMF, or sorry, the World Bank had a debt unit already in the 1950s that dealt with the problems of primarily of Latin America. It's interesting to hear this because they don't have it anymore. I mean, they got rid of it very quickly. It was run by a Yugoslav, Dragovic. And what he did was to propose a long-term development strategy. Okay. Now, we've been talking about development strategies in terms of sort of a bilateral relation. You're either running a system in which you have an export surplus, you have an export-led strategy, or you have a deficit and you're importing capital goods, right? Now, what he proposed was to say, well, normally what should happen if you have a successful strategy is that countries should be able to do both, but they should be able to do both in a planned system. Now, a planned system would mean what? Well, he said, if you look at a standard development strategy, a country would reach some sort of reasonable middle income status, probably in the space of, say, 20 to 30 years. We think about China. Policy in China changed in 1978, okay? And we're now, we're 40 years on. Basically, they had reached what we would call something like middle income status sometime around, 2010, something like that. So what Drag said is that what we want to do is to create a system in which you have developing countries that get guaranteed finance for a period, an initial period of, say, 20 years. And in that initial 20-year period, they're running external deficits, they're importing capital goods. But part of that strategy is not only to build up manufacturing, that is, instead of using direct import substitution, you also have a strategy which is export promotion, which is basically the strategy which Prebisch had originally designed. So that over that initial period, okay, you're running deficits on your external account, but the deficits on the external account are continually declining over time until you reach sort of the end of that 20-year period, until at that sort of stage, you're reaching a balance. Okay. Now, you've reached the balance on your external account. When you reach the balance on the external account, you start running an external surplus. When you're running the external surplus, you now have the ability to repay the borrowing that you've had over the first 20 years. And over this intermediate period, say it's another 10 or 15 years, okay, your external surplus, that is, your technology is improving, your balance of payments are improving, you're paying off that external debt. And eventually you reach a period in which what? Well, you reach a period in which you've paid off all of your external debt and you become an international creditor. Okay? Success. This is the sort of the crowning piece of your development strategy. Now, his argument was that this is what should be happening for developing countries. And the difficulty is that we don't have a financial mechanism which allows that to happen. Okay, why? Because over the first 20 years, now eventually what's going to happen is the same thing that happens to Argentina or happens to whatever, is that the creditors panic, they leave, you end up with a financial crisis, and the strategy fails. So what you need is this longer term strategy. So that if you think about this clearinghouse system, basically what the clearinghouse system is trying to do is to push the development financing into a longer and longer maturity. Now, the implications of the drag system would be to say, well, the current surplus countries are doing what? Well, in fact, they're investing in developing countries, but they're investing in them on the basis that this is a bond which has a zero return over the first 20 years. And only after the end of that 20-year period, it starts to pay off, right? So it's sort of what we call a balloon, all right? Now, these are financial innovations that we see all the time in the system, but we see them for much shorter periods, okay? But the problem is that the financial system hasn't yet been able to come up with a scheme or a system which allows this to happen on a long-term basis. I mean, basically, if you say you're the United States, and you say that we want to invest in a developing country. We're going to invest in a developing country on what basis? Well, we're going to invest now on a 30 or a 40-year or a 50-year basis. And the payment stream is going to be different from the standard payment stream. Okay, instead of issuing a 30-year global bond or a 50-year global bond that pays X% per year, you're going to have a 50-year global bond which says that over the first 5 or 10 years, it's not going to pay anything. And then it's going to start to pay on a progressive basis. And then at the end of 50 years, the thing is paid off. All right. Now, that was sort of the drag proposal. So basically what it said is that the difficulty here is the fact that we don't have the kinds of financial innovations which allow us to do that. Okay, and the question is, how would you do that? Well, the proposal was that the World Bank was supposed to do that. Okay, but it didn't. Okay, what did the World Bank do? The World Bank initially went into project financing, in which it lent money directly to developing countries, and they had to pay back the loans. I mean, if you remember HIPC, okay, HIPC, you're probably all too young to remember HIPC. This was the first problem that we had with lending to developing countries. Developing countries simply couldn't pay off, so we had to find a way of writing down all of that lending. So the question is, was the problem because the countries couldn't pay, or was it because the financial instruments were not appropriate? Okay, so this is the kind of thing. I mean, now I have to admit that at one stage I was hired by the UNDP to write up a proposal, and basically I wrote up that proposal as if it were my own. And unfortunately, I only discovered after it was published that drag had already done it. Okay, but it's something that it doesn't take rocket science to figure this out. That is, if you're looking at but if we talk about normal private sector financing, okay, normal private sector financing, banks have rules of thumb, firms have rules of thumb. Okay, we're going to repay everything within 3 years or 5 years. Okay, for a development strategy that doesn't work. Okay, so.
Professor, sorry, just one thing on the argument itself. When you were talking about the majority argument makes a lot of sense to me. But when you're saying that countries rack up deficits or rack up a debt/deficits, now they have to simultaneously manufacture and improve domestic demand. Great, that bit is fine. But at the same time, they have to follow a strategy of export promotion. But the problem is that world over, all credits and debits are balanced. Similarly, all exports and imports are also balanced, right? If there are two countries in the world, if one is an exporter, the other will be an exporter. One is an importer, the other will be an exporter, right? Not everyone can be an exporter at the same time. Someone has to be an importer, right? So given the number of developing countries, if you think of like the really advanced countries, well, they're not numerically, they're not in the majority, right? So doesn't this strategy also then run into the same problems that previous strategies have, in that some of these countries will simply never be able to pay that back, or you'll have to like keep sort of extending it, and then a default will happen, and fair enough, let it happen, right? But that same problem continues to persist. My point is that there is no automatic tendency for that balance to equalize even in 20 years or even in 50 years. There's nothing to say that it will definitely happen. And then, well, it's a similar problem to the current lending problems that we have, that isn't it? I'll stop here. No more from me.
Okay, the only thing I would say is that I think I mentioned yesterday this problem, this Japanese proposal of flying geese. And the point that you've raised is one that if you look at the literature on the Chinese experience, the initial period of the early 1980s also faced the same kinds of criticism, internal criticism. That is, in the Central Committee, you had people who argued, said, look, we're making all of these very simple goods, okay, and we're not going to be able to do this forever. Eventually, we're going to run out of people who are going to buy Barbie dolls from us. And the response was, well, we're not going to be producing Barbie dolls forever. Eventually, we're going to be moving up. As the rest of the countries move up, they're going to be opening up more or higher technology areas in which we can move in. And this is the argument, is that as long as the entire system is moving, then you don't have a problem, okay? So it depends very much on, as we say, what the lead goose happens to be doing. Now, when the lead goose starts to falter, then you do have a problem, because technically the lead goose is always, well, should always be the global deficit country. Okay, that's the responsibility, if you like, that's the responsibility of the lead goose. It's very interesting. There's a quotation, I didn't put it in this current deck of slides, but in the discussion of the immediate dollar scarcity in the post-war period, Keynes was very clear. Everybody was saying, well, we're always going to have this difficulty because the US is always going to be the country that has a surplus. And his argument was, well, the Americans are going to learn very quickly that now they're the dominant country. They're going to have very rapid increases in income. And I believe they're going to learn how to consume. And as they learn how to consume, eventually they're going to learn how to be a very large deficit country. Now, they ended up, or the US ended up being a large deficit country primarily for political reasons. Eventually, the economic reasons caught up. But in the initial period, most of the problems that were created by the US external balance was due to political and military expenditures. Eventually, the US did learn how to consume, and the Chinese were very clever in taking advantage of that. So this is the point, is that you're right, not everybody can do this at once, but not everybody is at the bottom of the what you would call it, the flock of geese that are moving up. The point is that you want to get as many people as possible into the flock so that they're part of that process of expansion.
Just one thing on the flock of geese, which is that the lead always rotates, right? They keep changing. So because the one at the front has to face all the drag and the tailwind that they create makes it easier for the rest of the flock. So as long as that happens, maybe this can work. But yeah, thank you so much for your explanation. This is really interesting and fun. Thank you.
Okay. Now, Juliana's been waiting patiently.
Yeah. Yeah, my question is a little bit more brief. It's just because as you were talking about the International Clearing Union, some of the features you've mentioned that would be really important for this institution would be, for example, this necessity to engage in more multilateral relations, and also to have some sort of autonomy with respect to the US financial interests. And this got me thinking about the New Development Bank, which is the BRICS Bank. And I just really wanted to hear if do you believe there's any potential that the New Development Bank could eventually evolve to a model closer to what you've been proposing in the lecture. If you see major constraints to this development take this direction in terms of how the bank behaves, or political constraints, for example. So yeah, I just wanted to hear more if we could be able to think of the New Development Bank and in terms of this framework of an international clearing union. Yeah.
Yeah, I mean, both well, all of these new initiatives, okay, are, I think, very important because most of them are in fact regional. And I think it makes a great deal of sense for countries to work on a regional basis. Now, whether it's a BRICS bank or whether it's an alternative to that sort of arrangement, the point is that it's the regional effort which allows for the possibility to take the first steps in this area. Now, the difficulty with these, with the banks, or the experience that I've noted that they have had, is that they still do tend to have, what should I say, national differences in terms of the operations of the banks. And this is one difficulty that you still have in terms of these sorts of institutions. Now, what do I mean by national regional differences? Well, if you take the multilateral basis of the clearing system, the basis is to maximize what in the European Union jargon we call subsidiarity. Okay, what you want to do is to keep things as much as possible determined and decided at the local level, rather than setting up an institution in which you have a management which is a shared management across countries. Okay, now, why is that important? Well, it's important because as long as you're working at the national level, obviously you're going to have differences, you're going to have disputes, but they're much easier to resolve than if the bank has a board to decide on what sort of investments it's going to make, and it has different national representatives, okay? Each is going to be representing his own national interests rather than the interests of the bank as a whole or the region as a whole. Okay, so that's the first difficulty I see in these things. And from, as I say, from the let me say, how can I put this? From the experiences of people who have been country representatives on the boards of these banks, I understand that there have been substantial difficulties in reaching common agreement. Okay, and this is the first point. The second point is that eventually, if these are going to be banks that are operating on a general regional level, eventually they're going to have to go to some sort of multilateral unit of account in order to set up these systems. So that, again, you're going to have this difficulty of different national representations, right? If you're familiar, let's see, now this is 2000, well, probably about 20 years ago now. We had a proposal in Latin America for a unit of account, regional currency, and a regional bank, Banco Sur. Now, Banco Sur doesn't exist. It never got off the ground. Didn't get off the ground. Why? Well, basically, it didn't get off the ground because Brazil was the largest and the most powerful country in the group. And Brazil did not see a national interest in supporting Bancosur. Basically, the idea was that the Brazilian government was backing up BNDES as the development bank, and they saw Bancosur as a competitor. Okay, and those are the sorts of difficulties that you want to avoid in terms of these the new banks. I mean, it's one thing to say, oh yes, we're going to have a new bank and we're going to have a whole lot of money and it's going to finance all sorts of things. Well, it's not quite that easy. And you need to have some sort of collaborative, cooperative structure in order to make these things function efficiently. Okay, Avon has been waiting. Oops, where did he go? Where did he go? No, he disappeared.
Yeah.
No, I'm here. I'm here.
You're here. Okay. If you're the
Hello.
Avon who wrote to me, I'll get back to you eventually.
No rush. I know you're busy, doctor. I know you're busy. So I actually and yeah, take your time on that. I don't really have like a particular question, certainly not anything well thought out or anything. Again, there was a lot of material. I actually have asked Dr. Fulweiler about clearinghouses a lot and like never really got anything. And then here you dropped a lot on us. So I guess, yeah, like a lot. So basically, unfortunately, my questions are going to kind of show that I haven't done much reading yet, because I want to ask like the sources for Koleski and Schumpeter's models of that plan of the augmented clearinghouses, because I've never heard anything about that before.
Okay, I can quickly give you the references are the Oxford Institute Bulletin, which unfortunately is very hard to find, but was the major organ for, because Koleski, Joseph Steindl, Schumpeter, all of these people worked together during the war in Oxford at the institute, and most of the things. Tommy Balog was also in that group. So that most of the things that they wrote were published in the bulletin.
Okay. And I guess, well, there was one question I kind of wrote down, but then I was thinking it kind of wasn't really that good. Then that's just some notes. I really thought the bit about the new financial instruments with like the half century maturity and stuff like that was very interesting. It makes a lot of sense given the context. I really like that. Hadn't heard anything like that before. So I guess I did have one sort of question about clarifying how the role of the lead goose in the flock changes when there is and is not like basically a national liability plan, the role of a international reserve currency. So like is really the only I don't know if you can't hear me probably.
Yep. No, I'm
Okay. So is the only like difference between the two in changing from like the bilateral to the multilateral, that aspect that the surplus current account countries end up sort of funding the deficit, the federal deficit of the deficit current account country? Is that like the only thing that changes in terms of, you probably can't hear me right now, can you?
No, I can still hear you.
Okay. But like in terms of the role or the relationship between the leader of the flock of the geese and the actual flock as a whole.
Okay, a good example of this is that, if you go back, say 10 years, 12 years, and then go back 20 years, okay? There was a period in which Japan for the US was, I won't say it was precisely the lead goose. Japan thought it was, but I'm not sure it was. But Japan was the villain, okay? So if you looked at the US political scene, the problem always was the bilateral balance with Japan. Okay, we had this massive deficit with Japan. This was terrible, and we had to do something about it. Okay, this was under Clinton, during the Clinton administration. Okay, go forward another 15 years, and now, okay, Japan, we got rid of them, and we've actually destroyed the entire Japanese economy to do it. But no, okay, that's fine. The problem got solved. But then we had China, and it was always bilateral balance with China. Now, if you're a sensible economist, you sort of tear your hair out and you say the bilateral balance means absolutely nothing. Okay? There's nothing economically relevant about the bilateral balance. The balance is what? Well, what you do is you look at the multilateral balance. Okay, China had a very large surplus with the US, but if you looked at the regional balance, China at the time had a deficit with the rest of the region. Okay, so you're saying, why are we messing around with the policies that are dealing with bilateral balances when those bilateral balances are not the things which are relevant? Okay, so that's the first difficulty that you want, and that's what the multilateral basis does. Now, it eliminates some of that political difficulty. So you say, okay, I don't have a bilateral deficit with China. What I have is that I have a surplus with the entire clearing union, and the payment of that is going to be what? Well, it's not going to be just Chinese debt. It's going to be, or Chinese assets. It's going to be assets from everybody else in the system. Okay, and that's why the Koleski proposal is sort of clever, because what he says is that, okay, what you're doing, it's like having a global investment fund. Okay, what you're saying is that somebody at Vanguard had a genius idea and said, what I'm going to do is I'm going to offer you a mutual fund that invests in the bonds of every deficit country in the world. So you don't obsess about that bilateral balance. Okay, and this does facilitate the problems, because if on the other side you're sitting there, you're China, and you say, yeah, okay, I've got this big bilateral with the US, but I've got the deficit with everybody else, and you can't change one of them at a time. You've got to change all of them. Now, that's the first part of the problem. Now, the other part of the problem is, where does that deficit come from, or where does the imbalance come from? So, if you read Michael Pettis tells you the problem comes in the US. The problem come from the excess liquidity creation in the US economy. All right. If you read Mr. Bernanke says, oh, it was excess savings in China. And then you say, yeah, but excess saving, how do you do that? And fortunately, the guys at the BIS had studied the financial balances sufficiently to discover that no, that argument didn't make sense. Bernanke doesn't understand the way the financial system works. Okay, but as long as you're on a bilateral basis, you're going to be using that mistaken formulation of the way the problem comes from. So what do? You say, oh, the Japanese save too much. The Chinese save too much. And their savings are simply flooding the world. And that's what's causing the imbalance. So what did we do? Well, we had the Chinese engage in financial liberalization. And we saw what happened. Sorry, the Japanese engage in financial liberalization. You saw what happened to the Japanese economy. Collapsed. Okay, not that that was a bad thing, but they didn't need to do that. They did that because of pressure from the US and because of the US not understanding where that bilateral balance came from and how to deal with it. Okay, so this is, I think this is why it's important to get these, well, to try and get these things onto a larger multilateral basis. So say, now we can't say, okay, this is your problem, you've got to do something about it. I mean, I may have mentioned, I used to, when I worked in the UN, I was often the deputy for the Secretary General for the meetings of the IMF. And, there you had all of the central, Greenspan would sit two chairs away from me and everything else. Okay. And, the US Treasury Secretary would come in. It was snow at that time. This was under Bush. And he would say, the Chinese have to do something to their exchange rate because they're stealing all of our things and they have a bad exchange rate policy, everything else. And Joe, who was the Chinese central banker at that time, very sensible guy, he would stand up and he would say, well, look, why should I change our exchange rate, okay, in order to make our exports more expensive and hurt employment in China? That's not a good strategy for us. If I'm going to do something, what we're going to do is let's increase the wages of Chinese workers. That's the way to do this, not by fiddling with the exchange rate. And unfortunately, poor Mr. Snow was not a good enough economist to recognize that the guy was right. That this was the way. If you have the increase in productivity should go where? It should go into domestic incomes and to domestic consumption, not screwing around with the exchange rate. Which makes it more difficult for you to run your economic policy. Okay, so that's the sort of response I would give, is that the more you can get away from thinking about these things as bilateral relationships and in terms of having somebody who is causing the difficulties for somebody else and you know how to fix it, the easier it's going to be to come up with adjustment policies which make sense rather than ones that are probably not appropriate.
Okay, thank you. I guess just one more really quick, just because I kind of do like the things you said about sort of the relations between like the US and China and US and Japan, and like how, I mean, it reminded me, I think, Finance is Warfare by Michael Hudson. He talks about some of those same things, definitely not in as much detail. But like, do you have any like preferred literature or scholar on like China and that development perspective? Again, just showing I haven't gotten around to reading much yet. Sorry.
Okay. In general, or I mean, there is a translation of the person who was the premier and the party secretary under Deng Xiaoping, Zhao Zhang, that basically he's the guy who got fired after Tiananmen and produced his explanation of his experience starting in the 1970s onwards of the Chinese domestic reforms, which is extremely interesting. There's also a book which has come out by Isabel Weber, an economist at UMass, who has done, she's done a lot of archival work, but I ran into Adrian Woods at a conference in France a month or so ago. And Adrian was working in the bank when the bank sent its first mission to China. And so apparently what Isabel used was primarily most of the notes that Adrian had written up while he was representing the bank in its negotiations with China over entry into the WTO. So wherever she got the stuff, it's extremely interesting to see the kinds of internal debates that went on in that case, including a very nice picture of Zhao Zhang meeting Milton Friedman, who was somebody who was invited to China to advise them on the problem of the liberalization of prices in the period just before Tiananmen, which is basically, I mean, Tiananmen has sort of two standard explanations. One was the student democracy movement, and the other one was the fact that Deng Xiaoping botched the introduction of price liberalization the first time, because he was a little bit too close to Friedman's advice rather than to what eventually was a system of dual liberalization of prices in the economy. But that's so those two things should be enough to keep you interested at any rate.
I'm definitely interested. Thank you for your time, Doctor. Thank you.
We have any other comments, questions to Professor Kregel?
Okay, we've exhausted everybody, I think, Jesse.
Yeah. Okay, good. Thank you so much, Professor Kregel, and thanks to all the students for having attended these three very interesting lectures. We hope to see you again on this program, Professor Kregel. It's a 10-month program, and we have special lectures, workshops, and so on. So we hope that sometime soon we will have you again for yet another interesting lecture. Thank you so much.
Okay, with pleasure.
Thank you, Professor. Thank you.
Okay.
Thanks, Prof.
Okay. Goodbye to
Bye,
everyone.
everyone.
Okay.
Goodbye,
Have a good
good
night
morning,
or a good
good
day,
night.
wherever you happen to be, wherever the sun happens to be for you.
Good night.
Thank you and good night. Bye-bye.
This